The UK's housing market is in free fall. Since October 2007, the average house has lost over £32,000, and mortgage lenders are reluctant to lend to anybody without a substantial deposit. But what does this mean for first-time buyers, homeowners coming to the end of their deals, and those looking to move? I'm here to meet with Ray Boulger, Senior Technical Manager of mortgage brokers John Charcol, to find out what exactly is going on. Just how low can interest rates go to improve confidence amongst lenders?
Well, there's no reason why bank rate can't come down to 0%. Whether it'll get there is obviously debatable, but I think it's certainly got further to fall. As far as borrowers are concerned, there will be a reasonable number of borrowers who took out 2-year or 3-year tracker deals which have pay rates at a negative rate to bank rate. So if we see bank rate coming down to 1% or below, there will be people who actually will have negative pay rates. And if those people have a repayment mortgage, then they will still have a payment to make to lenders because the capital element will be in excess of the negative interest. But anybody who's on interest only will actually find that the lender owes them money. And I doubt any lender has a system in place to actually pay their mortgage borrowers money on a monthly basis. So that's going to cause some interesting questions.
Is it a case of mortgage lenders just saying, we don't want the business?
Lenders are saying generally we don't want much business above 75% loan to value. The only area where there's real competition is for people with a big deposit, and the best rates are available up to 60% loan to value, pretty decent rates to 75% loan to value. Once you go above that level, there is very little competition, and above 80% loan to value, there are virtually no trackers around. And recently, trackers are what we've been recommending for most clients, preferably trackers with a drop lock option, which means that they can switch into a fixed rate whenever they choose. So it's the lack of finance available for mortgages that means there's not much competition in the market.
But is it not a self-fulfilling prophecy that if lenders saying we don't want to lend and buyers can't get a mortgage, then house prices will just continue to fall?
Certainly the fact that it is difficult for some people to get mortgages, and it's not just first-time buyers. Anybody, for example, with adverse credit will almost certainly not be able to get a mortgage these days. Likewise, people who need to self-certify their income will not be able to borrow more than 75%. So there are various categories of borrower who will be excluded from the market. And that fact clearly will mean that property prices will be lower than they would otherwise be because there's less demand. Once the market's stabilised, lenders will then be much more comfortable offering higher loan to values. So I think by the time we get to the middle or second half of the year, it will be easier to get a mortgage at 90% loan to value or maybe even 95%. So
what's your advice for people in negative equity?
A lot's going to depend on which lender they're with. Some lenders will offer customers another new business rate, in which case that's clearly an option. There's no way they can remortgage if they're in negative equity. So I think anybody in that situation will have to stay on whatever their lender's revert to rate is, which in most cases is standard variable rate. But in some cases, like Woolwich, it's actually a very competitive tracker rate at bank rate plus 0.75. They'll need to stay there until such time as either property values increase or their lender's prepared to offer them another deal.
But what if you need to move?
We had this sort of situation in the early 90s when we last had significant falls in property prices. And what some lenders were prepared to do then was to allow people to port their negative equity onto the new property. So effectively, you would be borrowing in excess of 100% on the new property. Now, one of the big differences between the early 90s property slump and now was that there was no shortage of mortgage finance then. With lenders not now having significant amounts of money to lend in the mortgage market and most looking to cut back on their lending, I rather doubt many lenders are going to offer that facility. So realistically, anybody in that situation will probably only be able to move if they can get permission from their lender to let the property, if the rental income is going to be sufficient to support the mortgage, which with interest rates coming down will increasingly be the case, and then they'll have to get a new mortgage for the new property. Having said all that, unless they've got a 10% deposit from their savings to put down on the new property, they'll still struggle to get a mortgage to move. So it's going to be difficult.
Is this good news for first-time buyers?
Well, clearly the lower property prices fall, the better it is for first-time buyers. But if they can't get a mortgage, it doesn't really matter what property prices are. There's going to be lots of people, particularly those who've been to university and are saddled with debts which may well run into 5 figures, who've just got no chance of finding a sufficient deposit to buy a property. And they, unfortunately, are going to have to wait until conditions ease and mortgages are available on a higher loan-to-value, by which time property prices will have risen. So, unfortunately, they are going to miss out on the cheapest prices.
And finally, do you think we'll ever return to the good old days of variety and competitively priced deals?
Well, these things tend to go in cycles, and I don't see us getting back to the good old days for the next few years. But I suspect that by the middle of the next decade, or maybe the second half of the next decade, yes, the exuberances will have reappeared, and we will be back to what you describe as the good old days. Certainly from a borrower's perspective, fair to call it the good old days.
Ray Boulger, thank you very much.
Thank you.